she has $50,000 of debt that has to be paid off. I'm going to put that in this side of the X curve, and I'll show you and I'll tell you why later. Then she has a mortgage that she's paying down. There's $450,000 remaining in her mortgage. I'm going to put it on this side of the X curve as well. And then she wants to, for her 3 kids, she wants to set up a fund of $100,000, or she wants to secure a fund of $100,000 to begin with for the education of her kids, right? So that they can go to college or higher education later on. So $100,000. Now, this might not seem enough in the beginning, but let me tell you, as she pays down her debt, as she pays down her mortgage, that coverage shifts to the education, right? That shifts down to education. That kind of gives you a hint also what's going to happen in this side of the X curve. Finally, we look at lost income, right? She wants to secure $150,000. So anytime in life that she's not able to bring in income, there would be a cushion, a buffer of $150,000 that she can tap into if she is no longer able to work and bring in that income. So that's $150,000 for lost income. I'm going to put it in this side of the X curve, right? Actually down here. So if we think of it as for quadrants, I'm going to be putting it down here, in this side. I can put it this side and this side, but anyway. So that kind of gives you an idea, right? Because this is the important point in this X curve. And you can see where we've split the coverage, right? This side, we have coverage that eventually she will no longer need. And here, we have the coverage that she wants to keep for the rest of her life. Right, so how do we implement that? We take the total, how much is it? 50,000, 450, 100, 150, that's $750,000 of coverage that she needs in the beginning. That's $750,000 of coverage that she requires in the beginning. Just making sure my mic's still on. Okay, so let's put that down. $750,000 of coverage. Big 750,000. That's the total coverage that she requires. Right? Now, how do we implement that into a policy? At time 0, she's 33 years old, so this is that point here. She's 33 years old. Right? Let's just extend that. Let's look at it until, let's say age 90. 90 years old. Right? So you can see that we break it down. We have this $150,000. That's what she'll need throughout the rest of her life. So that's this part here. This is that 150K. And then this part here is that 600K. So a total of $750,000. But we broke it down, $150,000 here, $600,000 here. Why did we do that? Right? Imagine this. If we load that full $750,000 into the Index Universal Life policy, compare that with loading just $150,000 in the Index Universal Life policy. Which one is going to be more expensive to start with, to begin with? You can already see which one is going to be more expensive. Why are we talking about the costs? because the cost will determine the growth of the cash value. If there's more cost, if more of her premiums go into cost, it will slow down the growth of the cash value. If more of her premiums go into cash value, it will boost the growth of her cash value. That's why we're looking at the cost at the very beginning. It's very important. So which one would be more cost more? Putting the full $750,000 or putting the $150,000? No brainer, right? That's why we break it down this way. This is going to be what's going into the IUL base amount or face value. The face value. Right? We're going to set it to $150,000. Now, the remaining $600,000, right? We are going to put that in what's called a term rider. Term rider. Because remember, these insurable needs are temporary, especially the long haul is the mortgage 20 years later. That's this point here. The 20th year, she no longer needs that coverage, so she can drop that coverage. She can drop that coverage, and she just needs to keep the $150,000 for the rest of her life. Right? She drops that. She has a base amount of $150,000 in her IUL. But notice at this point in the X curve, this is the growth of the cash value. This is the insurance she's paying for. Remember, this is the insurance that she's paying for. And this is the cash value. This is the cash value. Insurance she's paying for drops. Cash value keeps growing. Right? At this point in the 20th year, this conversion, intersection here, we already see that on top of the insurance that she wants to keep, there is already cash value that's built up. What does that mean? That means in terms of the total death benefit, she has $150,000 plus this amount of cash value already available. So if she passes away on the 20th year, she's not just going to be passing down $150,000. She will be passing down $150,000 plus this cash value. And this cash value is her equity in the policy, in her death benefit. This is her cash value. This is what she owns within the policy. This is her money that's growing. She's not paying for this amount of insurance. She's only paying for the $150,000 of insurance, and everything else above that from her cash value is her equity in her death benefit. And this is how we design the policy. We make sure she's covered in the beginning. We make sure we've driven down the costs at the start so that later on we can further reduce the impact of costs, and we allow her cash value to grow. She develops equity in her policy, and that builds the legacy that she can pass on to her beneficiaries. Let's say she passes away at the age of 90. That's the legacy she passes on, right? This cash value is her equity in the death benefit, and she can tap into the cash value in the future when she needs it. This is her financial safety net. And that's what And that's why we're using an indexed universal life to build that protection, that financial safety net for this client and for her family. Right, so let's put this into action. Let's design a policy based on this structure, this design. And let's look at the numbers. Let's look at the sample of the numbers, right? So to begin with, we keep the $750,000. You provide the $750,000 of coverage in the beginning. We split it out. $150,000 goes to the face value or the base amount of the index universal life, and the rest goes into a term rider that lasts for 20 years. And so how much is the premiums going to be? We want her to be max funding the policy. So $150,000 of coverage, that's max funded by $445 per month. $445 per month. In a year, that's $5,340 per year. $5,340 per year. That's the premium amount that she is putting in. And it's max funding it. Meaning, more of her premiums are going into cash value growth. And let's see. So, let's look at the cost ledger. Let's look at the cost ledger. And this is something other agents don't look at, but I'm not afraid of looking at the cost ledger. It's right here. And we see on the first year, the total charges, cost of insurance, the cost of the index, the premium loading or the premium expense charge, the PUC, everything for the first year. The total charges is $743. So out of $5,340, only $743 goes to charges. Where does the rest go? It goes to the cash value. So in her cash value, she would have $4,600 plus in her cash value. And what's available in the first year? Because we designed it this way, $1,500 or $1,500 is already available if she would require some money in the first year. $1,500 is already available, but $4,600 is already in her cash value in the first year, and that allows her cash value to steadily grow, to build up, so that later on she can stop paying premiums and the cash value takes care of the future expenses of the policy. She doesn't need to keep paying out-of-pocket premiums her entire life. She can stop paying premiums, and that will continue to take care of the policy. Plus, it's going to grow the surplus that she can use while she's alive as a financial safety net if something happens in the future and she needs cash, right? She has the cash value to tap into. She has the death benefit as living benefits that she can tap into. Talking about living death benefits, because we set it up at $750,000, if at this point here, in this area here of her policy, if something happens to her, if she has a chronic, critical, or terminal illness, she'll be able to take an advance of her death benefit, total death benefit. It's not just the $150,000, but the total death benefit. She can take an advance of it, tap into it for chronic, critical, or terminal illness, so it can take care of any expense that she requires because of those diagnoses, of those medical conditions, right? And on top of that, she has cash value that she can tap into as well if she requires fluid cash, right? So that's setting it up in the beginning. We set the $600,000 as a term rider coverage, which drops at the 20th year. which drops at the 20th year, right? But then, if we look at the illustration, this will allow her, because we dropped the amount of insurance that she's paying for, the cash value, whatever is left, is going to be able to take care of the future expenses of her policy, that she can stop paying at a certain point. She can stop paying premiums and she's still covered for the rest of her life. In fact, at a certain point, let's say in the 20th year, she would have paid $100,000 in premiums already, right? She would have paid $100,000 of premiums. This point here, the cash value in the 20th year would have already grown to around $170,000. So more or less $150,000 plus $170,000. She would have 320 or around that range of total death benefit existing in the 20th year. So even if she drops the term rider, she drops the $600,000 of coverage, she still has $320,000 of coverage left. It's not just $150,000 of coverage. This is what she's going to be paying for the rest of her life. But on top of that is the cash value, and the cash value is $170,000 at that point. So the total death benefit that she has, if she passes away in the 20th year, is $320,000. Much more than just what she's paying for, because she has that cash value there. And that cash value can make sure that the policy lasts for the rest of her life. And she could even pull out the $100,000 of total premiums that she's paid in. She can access the $100,000. Let's say she withdrew it. Let's say she withdrew that $100,000 of premiums that she's paid in, and that's going to be tax free. She can withdraw the $100,000 of basis, the total amount of premiums that she's paid in. Let's say $70,000 is going to be left. That $70,000 will still be able to sustain the policy so that it will protect her for the rest of her life. The illustration shows until the age of 121. It basically means she's covered for the rest of her life, even if she uses the $100,000 on the 20th year. Now, let's say at the age of 90, that's going to come out as the cash value is coming out as $1 million. $1,085,000. So at this point, it's 1.8 no 1.08. So I'll just round it off to 1.1 million. There's 1.1 million of cash value at age 90, right? Plus $150,000. So that's 1.2 million right there. That's 1.2 million at the age of 90 that she transfers to beneficiaries when she passes away at the age of 90. And remember, she already used $100,000, withdrawing that at the 20th year. So a total of 1.3 million that she was able to use while she was alive, or a total of 1.3 million of benefit that she has from the policy. Because we structured it this way, controlling the costs of the policy, making sure coverage applied is what she needs, exactly what she needs during the specific periods of time in her life,